learn with joy.
Hi, hello champions. Good morning. This is your CA Trilok. I am doing well. I hope you are also doing well. Today we are going to start with the chapter called as the standard costing. Let us have the introduction to this chapter and elaborately we'll do the questions based on the material costing. Now, listen to me carefully. What is standard costing and what we are going to study in the chapter standard costing is this chapter is also called as variance analysis. This topic is also called as the variance analysis. Why? Because please understand, in this chapter we are going to study one of the cost controlling technique. How to control the cost. How to control the cost means we are going to compare actual cost with the budgeted cost. When you compare these two, we'll get to know the variance. Such variance will be reported to the management of the company. The management will take the necessary actions to control the cost. So that standard costing is also called as cost controlling technique. Let us see how they are going to do the variance analysis. We all know that every manufacturing company at beginning of the financial year, they are going to prepare the budgeted data, budgeted financial data. At the end of the year, they'll get to know the actual financial data. Using this budgeted financial data, they can arrive at the okay. I'll do one thing. This budgeted financial data will be having two informations. One is budgeted sales. And one more thing is budgeted cost. Actual financial data also has two things. One is actual sales and also called as the actual cost. From this, we can arrive, from these two information, we can arrive at the budgeted profit. From this, we can arrive at the actual profit. Let me take an example. For namesake, I am taking the example. Budgeted profit is 10 crores, whereas actual profit is 8 crores. So please understand, at beginning of the financial year, they'll be having the budgeted information. Using budgeted information, by preparing the budgeted financial statements, they'll be arriving at the budgeted profit. Using actual information, they'll be arriving at the actual profit. Now the point is, as an example I taken, budgeted profit is 10 crore rupees, actual profit is 8 crore rupees. Now the management wants to know why there is a difference. That analysis is called as the profit variance analysis. This analysis is called as the profit variance analysis. So please understand. If you reconcile these two, we'll be calling it as the profit variance analysis. If you reconcile these two, we'll be calling it as the profit variance analysis. This reconciliation is called the profit variance analysis. Have you understand this, all of you? Now, the point is, why the profit get varied? See, we need to understand one more thing. Why there is a difference in profit? How come the 10 crores become 8 crores? It can be because of two reasons. One is because of the difference in sales and one more is because of the difference in cost. The profit can be varied. Because of change in sales, or because of change in cost. So we need to analyze. See, if you want to know the profit variance, we need to calculate two variances. We have to calculate two variances. One is sales variance and one more thing is cost variance. One is sales variance and one more thing is cost variance. Clear till now? When it comes to cost variance, cost is again classified into three more categories: material, labor, overheads. Because cost is a accumulation of the material, labor and overheads. Overheads is again divided into variable overheads and fixed overheads. So please understand this cost variance will broadly classify into 4 categories. What are the 4 categories means? This cost variance is broadly categorized into 4 categories: material variance, labor variance, variable overhead variance, at last fixed overhead variance. Look at here. This is first one is material variance. Material variance, labor variance, variable overhead variance, and then fixed overhead variance. All of you clear? Okay, now. So that means just I'm giving you the overview of the chapter. The overview of the chapter is profit variance analysis. To do the profit variance analysis, we need to calculate sales variance and then cost variance. When I say cost variance, we have to calculate all these 4 cost variances. When it comes to CA and CMA intermediate, the major focus is on the variance calculation. Analyzing will done at the final level. As of now, what we need to learn is just variance calculation. Now we need to learn how to calculate material variance, labor variance, variable overhead variance, fixed overhead variance, and sales variance. Let us start with the material variances. See, please understand, once we calculate the variances, based on the variances, the management will take the necessary corrective actions. The management will make the necessary decisions. When the cost is excess incurred, they'll try to control. When the sales is not doing well, when the sales is not promoting well, then again they'll take the necessary steps to promote the sales. Are you understanding? All of you? No. Till here it is fine. Now the point what we need to understand is, sir, in the entire discussion, we are not able to understand why they given the name called this standard costing. Why they use the word standard? So we need to understand standard cost. Before proceeding further, we need to understand what is standard cost. I'll give you one simple example to understand what is standard cost. Listen to me carefully. Budgeted cost of 1000 units at the rate of rupees 10 is equals to 10,000 rupees. Budgeted cost is also called the planned cost, forecasted, planned or forecasted. Okay, budgeted cost of 1000 units at the rate of 10,000 rupees. Actual cost of 800 units equals to 9,000 rupees. So budgeted cost is 10,000, actual cost is 9,000 rupees. So the difference is 1,000 rupees. Planned to incur 10,000, but actually incurred only 9,000. Planned to incur 10,000, but actually incurred only 9,000. There is a savings of 1,000 rupees. This 1,000 rupees, we are going to report it as favorable. See, here we are going to use the terminology called the favorable and adverse. What is favorable means the element which will increase the profit, we will be taking it as favorable. The element which will decrease the profit, we are going to take it as the adverse. Profit increases means favorable, profit decreases means adverse. Actual profit increase, actual profit decrease. Based on that, favorable and adverse. Here 1,000 rupees, I am reporting it as favorable to the management. The calculation what I done is correct. Is it correct? Just I am making the question mark. Is this calculation is correct? This calculation is absolutely wrong. So why it is wrong? Please understand, I am wrongly comparing 1,000 units budgeted cost with 800 units actual cost. 1,000 units budgeted cost, we are wrongly comparing with the 800 units actual cost. Then what is the right way of comparison, sir? We have to compare 800 units budgeted cost with 800 units actual cost. We should not compare budgeted cost of budgeted output with actual cost of actual output. There is a difference in volume. Which we are going to calculate the volume variance. At present, we are not going to discuss about the volume variance. So that what we are doing, this budgeted cost of budgeted output, we are converting into budgeted cost of actual output. Simply telling what we are going to do. This comparison is absolutely wrong because 800 units cost comparing with 1000 units cost. Then what is the right way of comparison? 800 units actual cost should compare with 800 units budgeted cost. 1000 units budgeted cost is 10,000. 800 units budgeted cost is 800 into 10, 8,000. Okay, now look at here. So what I'm going to do, budgeted cost of 800 units at the rate of rupees 10, which equals to rupees 8,000. Actual cost of 800 units, which equals to 9,000. There is a gap of 1,000 rupees. This is favorable or adverse means planned cost. See, for 800 units, how much is the cost planned? 8,000, but actually we are incurring 9,000 rupees. There is an excess spending of 1,000 rupees. There is an excess spending. Cost has been increased, profit will be decreased. So this 1,000 rupees will be reported as the adverse. This is the right way of calculation. This is absolutely wrong. Are you understanding? So please understand, this will be called as actual cost, this will be called as budgeted cost, whereas this will be called as the standard cost. This is called as the standard cost. What is budgeted cost means? Budgeted cost for budgeted output. What is standard cost means? Budgeted cost for actual output. Here it is budgeted output, here I am taking actual output. So budgeted cost for actual output, here it is budgeted cost for budgeted output. Anyhow, actual cost is actual cost for actual output. So what is standard cost? What is standard cost? Very simple. Budgeted cost for actual output. Budgeted cost of actual output. We'll take the actual output, multiply with the budgeted cost per unit. Actual output multiply with budgeted cost per unit, will get the standard cost. So what is the right comparison? Standard cost should compare with the actual cost. We should not compare budgeted cost with actual cost because there is a difference in volume, which is called as volume variance. Are you understanding? So look at here. In this chapter, types of cost. Types of cost. There are three types of cost. What are the three types of cost means here? Budgeted cost, standard cost, and then actual cost. What is budgeted cost means? Budgeted cost for budgeted output. What is standard cost means? Budgeted cost for actual output. What is actual cost means? Actual cost for actual output. When it comes to comparison, we are going to compare these two, but not these two, but not these two. We are going to compare standard cost with actual cost. We are going to compare standard cost with actual cost, but not the budgeted cost with actual cost because of difference in volume. Because of difference in volume. Have you understand this? Okay, so this is about standard cost. So let me write one word about the standard cost. What is standard cost means? What is standard cost means? Budgeted cost for actual output. Budgeted cost for actual output. Now what we need to understand is standard quantity of raw material. Standard quantity of what is standard quantity of raw material means? Budgeted quantity for actual output. Now we need to understand standard hours. What is standard hours means? Budgeted hours for actual output. Budgeted hours for actual output. This is how we are going to calculate standard cost, standard quantity, standard hours. Have you understand about this? All of you? Okay, now this is the basic intro. So from this introduction, what we understand is standard costing is one of the controlling technique, which is the cost controlling technique. So here we are going to do the variance analysis to control the cost. When it comes to variance analysis, the main thing is profit variance analysis. To do the profit variance analysis, we are going to do the sales variance as well as cost variance. When it comes to cost variance, material, labor, variable or fixed overhead variances. To do this analysis, first we need to understand what is standard cost. What is standard cost means? Budgeted cost for actual output. We should not compare budgeted cost directly with the actual cost, because this is budgeted cost is for budgeted output, actual cost for actual output. There is a difference in output, so we are not comparing budgeted cost with actual cost. So what is the right way of comparison? Means budgeted cost for actual output, budgeted cost for actual output with the actual cost for actual output. Budgeted cost for actual output is called standard cost. Actual cost for actual output is called actual cost. So we are going to compare standard cost and actual cost. We will never compare the budgeted cost with actual cost. Clear till now? Understanding? Okay, now let us start with material variances. Material variances. Listen to me carefully. Listen to me carefully. See here. When I say material variances, how to calculate material cost? Material cost equal to quantity into price. Material cost equal to quantity into price. Let me take an example. Budgeted material cost equal to 10,000 rupees. Actual material cost equal to 12,000 rupees. Budgeted material cost is 10,000. Actual material cost is 12,000. Now, one thing you need to understand. One thing you need to understand. Please understand this properly. See here. Budgeted material cost is 10,000 and actual material cost is 12,000. There is an increase of 2,000. There is an increase of 2,000 in the actual material cost. That increase would have been happened. That increase happened maybe because of quantity or maybe because of price. See, the difference is 2,000. The difference is 2,000. This 2,000 will be called as material cost variance. Material cost variance. When it comes to 2,000 rupees of variance, it may happen because of price or it may happen because of quantity. So we need to know out of this 2,000, we need to know out of this 2,000 how much is because of quantity and how much is because of price. So this 2,000 will be divided into two categories: material price variance and material usage variance. Material price variance and then material usage variance. The only reason is two: quantity and price. Price is called material price variance and quantity is called as material usage variance. Have you understand till here? All of you? Now, this is about single material. When there is only single material, so there will be only two reasons. One is because of quantity and one more is because of price. One is because of quantity and one more is because of price. But now, when there is a multiple products or multiple raw material in the company, then apart from this quantity and price, there is one more reason called as the mix variance. There is one more reason called as the mix variance. I'll give you the example. There is a person. There is a person called as Ram. He is distributing milk all over Bangalore. He is distributing milk all over Bangalore. Just I'm taking the example. Let me take an example. Initially, he started mixing for every 10 liters of milk. For every 10 liters of milk, he started mixing 1 liter water. For every 10 liters of milk, he started mixing 1 liter water. 10 liters, okay. 10 liters milk. Each liter is 40 rupees. Total cost comes to 400 rupees. And 1 liter water. Each liter is 20 rupees. Let me take an example. Each liter is 20 rupees. Bisleri water. Okay. 40 into 10, 400. 20 into 120. 400 plus 20, which equals to 420 rupees is the actual cost to get the output of 11 liters of milk. 10 liters milk plus 10 liters, 10 liters milk plus 1 liter water equal to 11 liters milk. Okay, now this is the standard. When it comes to aqueous, he slightly change the proportion. For every 1 liter milk, he is mixing. For every 1 liter milk, he is mixing 10 liters water. Just example. Okay. 1 liter milk into 40, 10 liters water into 20. 40 into 1, 40, 20 into 10, 200, which equals to 240 rupees to get the same 11 liters output. Please understand, here two types of raw materials, milk and water, and price is also same, 40, 20. What is changing is mix proportion. Mix proportion is changing. Here the mix proportion is 10:1. Here the mix proportion is 1:10. Due to change in mix proportion, the cost also change. So that means when there is a multiple products, three variances can be possible. Might be because of price, might be because of quantity, might be because of mix. So whenever it comes to material cost variance in case of multi-product company, whenever you calculate the material cost variances, we need to report how much is because of price, how much is because of quantity, and how much is because of mix. To calculate these three variances, I'll give you one format. I'll give you one format which is very simple format. If you learn this format for the material variances, the same format is applicable for labor, the same format is applicable for variable overhead, fixed overhead, sales variance. All the variances can be calculated using the same format. Names will change, but formulas will not change. Are you understanding? Look at here. First, we are going to have computation table. A will be having computation table. We'll be having computation table. Just I am drawing the format. First we'll be writing name of the material. First we'll be writing name of the material. Then we'll be having 4 columns. Column number 1, column number 2, column number 3, column number 4. This is material. SQ into SP, AQ into AP, AQ into SP, RAQ into SP. And one more thing, especially for CA intermediate students, only this format, whatever the format that I am following, question number 5 of practical questions has been in that question only. The institute has followed this format. Remaining all the questions they solved in their own format. But what I mean to tell you is like you can apply this format for any question from the study material. You will be arriving at the right answer. No need to panic. You follow the same format. Few questions has been done using this format. No need to worry about the format. Ultimately, we need to get the right answer. Whatever the calculation that we done at the end, it should be right. It should be correct. What I mean to say, if you follow this format, it becomes very simple. The chapter will become format oriented. Even if you don't know the concept, it's easy to solve the questions. Okay, look at here. I'm taking totally 4 columns: SQ into SP, AQ into AP, AQ into SP, RAQ into SP. Okay, now once we prepare this, okay, you all know that SQ stands for standard quantity, SP stands for standard price, AQ stands for actual quantity, AP stands for actual price, RAQ stands for revised actual quantity, which is also called as the revised standard quantity. RAQ is also called as RSQ. RAQ is also called as RSQ. Okay, what is what? I'll explain with one of the example with illustration number 3. Okay, this is about the computation table. Then we are going to calculate the variances. B, variance calculation. Variance calculation. Look at here. First, material cost variance. Material cost variance. What is the formula means? 1 minus 2. It means that column 1 minus column 2. It is meaning that column 1 minus column 2. In column 1 we have standard cost. In column 2 we have actual cost. The difference is the cost variance. Okay, next. This material cost variance will classify into 2. Maybe because of price or because of quantity. So we'll be calling it as material price variance. Material price variance. And then material usage variance. In place of quantity, I'm using usage. You can use the quantity also, nothing wrong in that. Material usage variance 1 minus 3. Material price variance 3 minus 2. 3 minus 2. What is the meaning of this? Column 3 minus column 2. Look at here. Column 3 minus column 2. If you look at these two columns, which quantity they are using? Actual quantity in both the columns. The difference between column 3 and 2 is only because of price. In column 3, we are using standard price. In column 2, we are taking actual price. The difference, whatever we are getting, that is because of price variance. Okay, next. Material usage variance 1 minus 3. Look at here. First column, third column. First column, third column. If you look at the first and third column, price is same, standard price. So it is not because of price, it is because of quantity. Here it is standard quantity, here it is actual quantity. So that we've taken it as 1 minus 3. Have you understand this? Next. When it comes to quantity, again we have to know. Again we'll classify into 2 categories. What does that mean? Material mix variance. Material mix variance and then material yield variance. material mix variance, and then material yield variance. Mix variance is 4 minus 3, material yield variance is 1 minus 4. Let me clarify this. Again, let us understand usage variance. 1 minus 3. Look at here. 1 minus 3. First column standard price, third column standard price. It is not because of price. First column standard quantity in standard mix. We are going to mix in the proportion of standard mix. Third column actual quantity in actual mix. Please understand. First column standard quantity in standard mix proportion. Third column actual quantity in actual mix proportion. So the difference is because of two reasons. One is because of quantity and one more is because of mix. One is because of quantity and one more is because of mix. So first and third column difference because of two reasons. One is because of quantity and one more is because of mix variance. So that 1 minus 3 again we are classifying into how much is because of mix variance and how much is because of yield variance. Mix variance formula is 4 minus 3. Mix variance formula is 4 minus 3. Okay, before that what you need to understand is RAQ. RAQ stands for revised actual quantity. What does it mean? Actual quantity in standard mix. Revised actual quantity, nothing but actual quantity in standard mix. Are you understanding? Revised actual quantity means actual quantity in standard mix. Clear? Okay, now. So here what we need to understand is 4 minus 3. 4 minus 3. Look at here. Let me take fourth column, third column. If you look at these two columns, standard price, not because of price. Actual quantity, not because of quantity. It is purely because of mix. Actual quantity in actual mix. Here, revised actual quantity, nothing but actual quantity in standard mix. It is purely because of mix. So that we take 4 minus 3 as a mix variance. At last 1 minus 4. It is purely because of quantity. 1 minus 4 is purely because of quantity. Look at here. 1, 4. Standard price. Standard quantity, standard mix. Revised actual quantity in standard mix. So mix is same. What is changing? Here it is standard quantity, here it is actual quantity. The difference is because of quantity. So that we are calling it as material yield variance, which is also called as the material sub-usage variance. One more name for this is sub-usage variance or material productivity variance. These are the different names. Productivity variance. So this is the format which helps to calculate material cost variance, price variance, usage variance, yield variance, and then mix variance. Are you understanding? Usage only we are classifying into two, mix and yield. If you add these two, you will get usage. If you add these two, price and usage, you will be getting cost variance. All of you clear about this? Understanding? Okay, now let us start doing few questions from the material cost variances. Let me take the illustration 3. I am taking illustration 3. Look at here. Look at the question. The standard cost of chemical mixture is as follows. 40% material A at 20 rupees per kg, 60% material B at 30 rupees per kg. This is the standard cost information. They given the prices, standard prices given. There are two types of material. So it's a multi-material variance. We need to calculate mix variance also. Okay, there are two materials, A and B. And what is the mix proportion? 40%, 60%. This is the standard mix. This is the standard mix and this is the standard price. Okay, next. A standard loss of 10% of input is expected in production. The cost records for the period showed the following usage. Look at here. Cost records of the period shows following usage. This is the actual. Usage stands for actually used. What is the actual quantity of A 90 kg? What is the actual quantity of B 110 kgs? And what is the actual price of A 18 rupees? What is the actual price of B 34 rupees per kg? So they given actual price and they given actual quantity AQ AP given. Okay, now the quantity produced was 182 kgs of good product. So this is the output, actual output. This is the information given. They are asking cost, price, usage, but we are going to calculate the mix and yield also. For just for reference sake, just to get the ideology about that, we are going to calculate the mix and yield variance also. Let us go by our format. Let us take our format and do along according to that. Look at here. I am copy pasting the same format. Computation table. Copy, paste. Imputation table. There are two types of material A, B. First, what I'm going to do, what all the information is known, I'm going to write that. So look at here. Standard price is known 20, 30. Material A 20, material B 30. Here also standard price. So 20, 30. Here also standard price 20, 30. But here actual price. Look at here. Actual price is 1834. 1834. Okay, now actual quantity is given 90 kgs, 110 kgs. 90 kgs, 110 kgs. 90 kgs, 110 kgs. 110 kgs. 110 kgs. Have you understand till here? Now, what is required is standard quantity and revised actual quantity. Let us calculate these two. Look at here. Working notes. In that right A. Calculation of standard quantity. What is standard quantity? Budgeted quantity for actual output. Budgeted quantity for actual output. Look at the question. Look at the question. They mention standard loss is 10% of input expected in the production. So whatever input that we given, 10% is the loss and balance will be the output. Look at here. Look at here. Whenever it comes to standard quantity, I always prefer to follow input output format. You just take this format, it helps you a lot to calculate the standard quantity, input, output. Listen to me carefully. What they mention, if you give 100 kgs input, the output will be only 90 kgs. Why? Because there is a 10% loss. Standard loss of 10%. If you give the input of 100 kgs, we'll get the output of 90 kgs. Clear? Next. And what is the output? What is the actual output? This is the budget. This is the budget. But what is the actual output? They clearly mentioned in the question 182 kgs. The actual production is 182 kgs. Actual production is 182 kgs. To get the output of 182 kgs, how many kgs we have to give it as input? How many kgs we have to give it as input? Let us take the calculator. So 182 into 100. 182 into 100 divided by 90. 202.22. 202.22 kgs. This is the quantity allowed, which is called a standard quantity. This is the standard quantity permitted. Please understand, look at this. Actual quantity what they consumed is 200 kgs. Actual quantity what they consumed is 200 kgs. What is standard quantity? Means quantity permitted, allowed. How much is allowed by the management? Permitted by the management. They consume 200 kgs in the proportion of 90, 110. But how many kgs permitted? 202.22 kgs. 202.22 kgs permitted to produce 182 kgs. To produce 182 kgs, 202.22 kgs permitted. Now this 202.22 kgs, we need to bifurcate between both raw material A, raw material B. These are the two raw materials A and B. Standard quantity is standard mix proportion. Look at the question. What is the standard mix? Standard mix is 40%, 60%, which is nothing but 4:6, which is number 2:3. Which is nothing but 2:3. 4:6 or 2:3. Now divided by 5 into 2. 80.89 divided by 2 into 3. 121.33. 121.33. 80.89 kgs. 121.33 kgs. Look at here. Here I'll take 81.89. 121.33. Understood? Now the time to calculate the revised actual quantity. We all know that. B. Calculation of RAQ. Calculation of RAQ. What is RAQ? Revised actual quantity, which is also called as revised standard quantity. What does it mean? Simple. Actual quantity in standard mix. Actual quantity in standard mix proportion. See, why we are doing all this calculation? To calculate three variances: price, because of price, how much is the cost, because of how much is the variance, and because of quantity, how much is the variance, and because of mix, how much is the variance. Okay, RAQ stands for revised actual quantity. Actual quantity standard mix. How much is the actual quantity? Actual quantity equal to 90 kgs of A plus 110 kgs of B, which equals to 200 kgs. We'll divide in standard mix proportion between A and B. Are you understanding? What is the standard mix proportion? 2 is to 3. 2 is to 3. Then it will become 80 kgs and it will become 120 kgs. 80 kgs, 120 kgs. Here I'll take 80 kgs, 120 kgs. Now we need to calculate the cost one by one. Look at here. 81.89 into 20. 1637.8. 121.33 into 30 equals to 3639.90. 90 into 18. 1620. 110 into 34. 3740. 90 into 20. 1800 into 20. 1800. 110 into 30. 3300. 80 into 20. 1600. 120 into 30. 3600. All of you clear? So we're done with the computation table. See, in computation table, the only complication is calculation of standard quantity divided actual quantity. If you understand this properly, the question is very simple. In majority of the question, the requirement will be same. Are you understanding? Now let us write the variances. Look at here. So we're done with the A, B. Variance calculation. Variance calculation. Look at here. Look at here. First, we'll take material cost variance. Roman number 1, material cost variance. Material cost variance. What is the formula? 1 minus 2. First, we'll take it for material A. Material cost variance 1 minus 2. First, we'll take it for material A. 1637.8 minus 1620. Look at here. Permitted cost is 1637.8, but actually incurred only 1620. There is a savings. See, the permitted cost is 1637, but actually incurred only 1620. There is a savings of 17.8 rupees. Now look at here. Yeah, 1637.80 minus 1620, which equals to 17.80. We are going to report it as favorable. Why it is favorable? Permitted is 1637.8. But actually income is only 1620. There is a savings of 17.80, so we will report it as favorable. Simple sense, I'll tell you. When it comes to cost variance, positive means favorable, negative means adverse. Positive means favorable, negative means adverse for all the cost variances in our format. Okay, next B. When it comes to B, first column is 3639.90. 3639.90 minus 3740. There is a adverse. there is a adverse. $3,639.9 minus 3,740 equal to 100, 100.10, 100.10 adverse. So what is the net adverse? 17.8 equal to 82.30 is the net adverse. 82.30 is the net adverse. 82.30 is the net adverse. Are you understanding? Next, Roman number 2, material price variance. According to us, what is the formula? Material price variance, column 3 minus column 2. We'll take A, B separately. First we take column A, sorry, for material A, column 3, 1800 minus 1620. 1800 minus 1620, which equals to 180 favorable. 180 favorable. B, 3300 minus 3740. 3300 minus 3740, which equals to 440 adverse. The net amount is 260 adverse. The net amount is 260 adverse. Next, Roman number 3, material usage variance. Material usage variance 1 minus 3. First we'll take A, B. A, first column, 1637.8, 1800. 1637.80 minus 1800, which equals to, we get negative value, so adverse. 1637.8 minus 1800 equals to 162.2 negative. 162.2 negative adverse. Next, B, first column, 3639.90, 3300. 3639.90 minus 3300, positive. 339.90 positive, favorable. So the net amount is plus 3039.9, 177.7, 177.70 favorable. If you add favorable adverse, we'll get the net adverse 82.30. Are you understanding? Okay, now Roman number 4, material mix variance. Material mix variance. 4 minus 3. 4 minus 3, A, B. Fourth column, 1600, 3600. 1600, 3600 minus 3. Third column is already here. 1800, 3300. Take the net value. 200 rupees adverse, and here it is 300 rupees favorable. 200 rupees adverse. See, 1600 minus 1800, negative 200. So adverse. 3600 minus 3300, positive 300 rupees favorable. Net amount is 100 favorable. Okay, next. Number 5, material yield variance. Material yield variance 1 minus 4, A, B. First column, 1637.80, 3639.90 minus fourth column, 1600, 3600, which equals to 37.80 favorable, positive value. Here it is 39.90 favorable, again positive value. Total 37.8, 37.8 plus 39.9, we go to 77.7, 77.7 favorable. If you add these two, that is equal to this. If you add these two, that is equal to this. So we're done with the crystal clear concept clarity on the material variances. All of you clear about this? Okay, now let us do application oriented question. Application oriented question of the material costing. Look at here. That is question number 4, I think. Yeah. Look at the question number 4. ABC Limited produces an article by lending two basic raw materials. It operates a standard costing system, and the following standards have been set for raw materials. Material A, B, standard mix 40%, 60%, standard price 4 rupees, 3 rupees. Okay, so this is the standard mix. Let me write one by one. This is the standard mix, and this is the standard price per kg. Next, the standard loss in processing is 15%. During April, the company produced 1,700 kgs of finished goods. So this 1,700 kgs is the actual output. 1,700 kgs is the actual output. Okay, now the position of stock and purchases for the month of April are as under. So this is stock as on 1/4/2021, nothing but opening stock. Stock as on 30/4/2021, nothing but closing stock. And this is the purchases during April 2021. Okay, now, so purchase they given kgs and value. Kgs and value, we can calculate the price. How to calculate price? See, this is the actual price. Let me calculate actual price. 3,400 divided by 800. 3,400 divided by 800 equals to 4.25. Actual price is 4.25. Here 1,200, sorry, 3,000 divided by 1,200 equals to 2.5. Actual price is 2.5. Okay, now opening stock of material is valued at standard price. Listen. Opening stock of material is valued at standard price. Sir, why they want to value at standard price? Let us understand this. Please understand, when it comes to material variances, there are two types of plans. What are the two types of plans? Means single plan, partial plan. Look at here. Single plan and then partial plan. What is the single plan, partial plan? The single and partial plan is regarding the price variance. This is specific adjustment. This is one of the specific adjustment which you need to understand to get the clarity on the material cost variances. Listen to me carefully. 1,000 kgs purchased at the rate of rupees 10. At the rate of rupees 10. Okay. Let me take an example. Okay. Let me take it as 12. 1,000 kgs purchased at the rate of rupees 12. At the rate of rupees 12. Standard price equal to rupees 10. Permitted price is rupees 10, but actually incurred is 12 rupees. Okay. Now, out of 1,000 kgs, 800 kgs has been consumed. 800 kgs has been consumed. Now the point is, when it comes to price variance, we all know that if you observe these two, there is a price variance of 2 rupees. This is actual price, and this is standard price. What is the standard price? Is the price allowed. When it comes to purchase manager, purchase manager has to purchase by at the rate of 10 rupees. But at what rate he is purchasing? 12 rupees. He is incurring 2 rupees extra. The 2 rupees is called the price variance, which is adverse to the organization, which is adverse to the company. 2 rupee price variance for how many kgs? 1,000 kgs. For how many kgs? 1,000 kgs. So 1,000 kgs into 2 rupees, which equals to 2,000 rupees is the total adverse. 2,000 rupees is the total adverse. Now the point, listen to me carefully. Now the real examine, the real concept starts. Listen to me carefully. If you recognize the price variance, for the quantity purchase, that is called as single plan. Entire quantity of 1,000 kgs price variance is recognized in the same year, in the current year. So we'll be calling it a single plan. Now, if you recognize for 800 kgs price variance, balance 200 kgs, which is the closing stock, will be carried forward to next period in the name of opening stock. Balance 200 kg, which is the closing stock, balance will be carried forward to next period in the name of opening stock. So if you recognize only for 800 kgs to the extent of consumption, we'll be calling it as partial plan, because partially recognized in the current year and partially recognized in the next year. This 200 kgs price variance will be recognized in next year. When it comes to single plan, total price variance is 2000 rupees adverse. When it comes to partial plan, in the current year, 800 kgs, each kg variance is 2 rupees, that is equal to 1600 rupees recorded in the current year, and 200 kgs into 2 rupees, 400 rupees will be recorded in the next year, so that it is called as, see, current year we are recording partial out of 2000 rupees, we are recording only 1600 rupees, so that it is called as partial plan. Entire 2000 rupees recorded in the same year means we will be calling it as single plan. Have you understand till here? So simple. Single plan, partial plan. Single plan means price variance will be recorded based on purchase. Partial plan means price variance will be recorded based on consumption. Have you understand till here? All of you? No. If it is single plan, now the question mark is closing stock. Look at here. 1000 kgs into 2 rupees, 2000 rupees adverse recorded in the current year. 2000 rupees adverse recorded in the current year. Out of 1000 kgs, how many kgs consumed? 800 kgs consumed and 200 kgs lying as closing stock. This 800 kgs is okay. Now 200 kgs. This 200 kgs will be taken out to next year. This 200 kgs has to be taken out to next year. At the time of taking out to next year, this 200 kgs should be recorded. This 200 kgs should be recorded what price? Should be recorded actual price of 12 rupees or standard price of 10 rupees. That is the question mark. The 200 kgs which will be carry forward to next year, should be recorded at 12 rupees or 10 rupees. At what rate we need to recognize, or at what rate we need to account? Please understand, we need to account at standard cost, we need to account at standard price, we need to account at standard price of 10 rupees, because this gap of 2 rupees, this difference of 2 rupees is already accounted in the current year. This 1000 units include 200 units, which is the closing stock. 200 into 2, 400 rupees is already accounted in the current year. 400 rupees is already accounted in the current year. So for the next year, we will carry forward only at standard cost. So single plan should be valued at standard cost. Single plan means stock should be valued at. Single plan means stock should be valued at standard cost. Partial plan means stock should be valued at actual cost. Because here we didn't recognize the variance. To the next year, we need to carry forward 200 kgs at the rate of 12, including 2 rupees. Because 2 rupees is not accounted here. So how to remember this? Just to give you the blind hint. Single plan means standard cost. Partial plan means actual cost. Single plan, yes. Standard cost, yes. Single plan is that if the management is following single plan, evaluate the closing stock using standard cost. Are you understanding, all of you? So what does it mean? Why I am explaining all these things? In this question, they mention opening stock of material is valued at standard price. What does it mean? That variance is already recorded in the last period. So they are evaluating at standard price. Closing stock of last period is the opening stock of current period. Closing stock of last period valued at standard price. Why? Because of single plan. So opening stock also to be last year valued at standard price means current year also we have to take at standard price. Opening stock. Have you understand this, all of you? No. That means the final conclusion is the company is following the single plan. Clear? Understood? Now, if the company follows single plan, then what they need to do? The entire purchase quantity has to be the variance has to be recorded for purchase quantity. But in this question, the institute has been solved by taking the consumption. Sir, why they are doing like this? The company would have been changed the policy. Sir, where they mentioned? Did they mention in the question? No. So please understand, when they given this kind of question in the examination, opening stock alone you value at standard price, but the remaining calculations to be done based on consumption. Based on consumption. Now listen to me carefully. Listen to me carefully. Look at here. How to calculate consumption? Consumption equal to opening stock plus purchases minus closing stock. Here we have two types of material. Material A, material B. Opening stock of material A 35 kgs, material B 40 kgs plus purchases. What is the purchase of material A? 800 kgs, material B 1200 kgs minus closing stock. What is the closing stock of material A? 5. What is the closing stock of material B? 50. If we exclude this, okay. Now, what is the consumption? 830 kgs. Total consumption is 830 kgs. Here it is 1190 kgs. 1190 kgs. Okay. Now, so this is the info given. What they are asking to calculate? They are asking to calculate price, usage, yield, mix, and total cost. All the variances. So first, what we need to do? Computation table. See, as I told you, first we need to prepare the computation table and then variances. But in few questions, when there is a multiple adjustments, don't prepare the computation table. Directly follow the formulas. 1 minus 2. We know 1. What is 1? SQ into SP. What is 2? AQ into AP. SQ into SP minus AQ into AP. Just for remembrance sake, I designed the table and calculation. Are you understand? To remember the formulas. See, if no additional information, if it is straightforward question, we can follow the same format. When there is a multiple adjustment, don't follow the format, directly take the formulas. When it comes to 3 minus 2, what is 3? AQ into SP. What is 2? AQ into AP. Are you understanding? All of you, you just remember the format. Using the format, take the formulas. Okay, let us start doing this question. Let us start doing this question. Question number 4. Question number 4. Or illustration number 4. Look at here. Illustration number 4. Look at here. First, material price variance. What is the formula? Material price variance is 3 minus 2. What is 3? AQ into SP minus 2. AQ into AP. AQ into SP minus AQ into AP, which equals to, out of these two, take the common of AQ. Then it becomes standard price minus actual price. Standard price minus actual price. Are you understanding? Now look at the question. Or else we'll do one thing. We'll take separately, because there is a small adjustment. I'll tell you. Don't worry. See here. Let me write this calculation. Look at this. First. Actual quantity consumed. Actual quantity consumed is 830 kgs. Okay. 830 kgs into, first we'll do it for material A. 830 kgs into, what is the standard price? Standard price is 4 rupees. B. What is the actual quantity consumed? 1190 kgs into, what is the standard price? 3. Okay, minus. Okay, first we'll do it for A, then we'll do it for B. 830 kgs into 4. Okay, 830 kgs into 4 minus actual quantity. Please understand, when it comes to actual price, when it comes to C, standard price is okay. When it comes to actual price is applicable only for the current year purchase. Please understand. Actual price has to be taken for the current year purchase. Opening stock is always valued at standard price. Here what you need to understand is totally 830 kgs is the consumption. This 830 kgs will divide into two: opening stock consumption and current period purchase consumption. What you need to understand is that in this question we are doing under the base of FIFO method. In the options of information, we'll always take FIFO, first in first out. Totally 830 kgs consumption. That 830 kgs, look at here, that 830 kgs consumption, first they would have consumed 35 kgs, then they would have consumed balance out of 830, 35 kgs from the opening stock, balance 795 kgs from the purchases. This opening stock should be valued at standard price, clearly stated in the question. Clearly stated in the question, that is always valued at standard price. So what we need to do here, actual quantity. Look at here. Okay. Actual quantity, first we take opening stock consumption 35 kgs into at standard price. What is the standard price? 4 rupees. Plus balance 795 kgs from the current year purchase. What is the current year purchase price? We taken the actual, oh, I deleted that. Okay. So 795 into 4.25. 795 into 4.25, which equals to, or else I'll do one thing. Which equals to 830 into 4 equal to 3320. 3320 minus 35 into 4, 140. 795 into 4.25. 4.25 equals to 3378.75 plus 140 equals to 3518.75. 3518.75, which equals to minus 3320. 198.75 negative. 198.75 negative. So adverse. 198.75 negative, adverse. Okay. Now we'll do it for B. B equal to totally how many kgs consumed? 1190 kgs consumed into what is the standard price? 3 rupees. Plus out of 1190 kgs, first they would have consumed opening. Sorry, minus. First they would have consumed the opening stock. Opening stock should be valued at standard price. What is the standard price? 3 rupees. Plus balance 1150 kgs valued at 2.50, which equals to, this is sorry, here we'll take the actual quantity 1190. 1190 is the actual consumption. Okay, now fine. 1190 into 3. 1190 into 3 equals to 3570. 3570 minus 40 into 3, 120. 1150 into 2.5 equal to 2875 plus 120 equal to 2995. 2995 equals to 3570 equals 575. 575 rupees favorable. 575 rupees favorable. So the net amount is 575 favorable minus 575 favorable minus 198.75 equals to 376.25 favorable. 376.25 favorable. This is how we need to calculate the price variance. In this question, price variance calculation is very important. Remaining variance are very simple. Price variance, we have to be careful when there is a purchases. When the question is given purchases, be careful. And they clearly mention opening stock to be valued at standard cost. So that here also, when it comes to opening stock, we are evaluating using standard cost. And the remaining consumption we are evaluating using current period price. Material price variance is done. Now, number 2, what they are asking? Material usage variance. We all know that. Material usage variance. Let me explain this. Simple. According to us, what is the formula? 1 minus 3. 1 minus 3. So let me write the one is what? Material price variance equal to 1 minus 3. What is 1? SQ into SP minus what is 3? AQ into SP. Out of these two, which we can take common SQ. Sorry, SP. SQ minus AQ into SP. Let me take A, B. We need to calculate standard quantity. We need to calculate standard quantity. We'll calculate that. And we know the actual quantity. What is the actual quantity of A consumed? 830. What is the actual quantity of B consumed? 1190. Into what is the standard price? 4 rupees, 3 rupees. Now what we need to do is we need to calculate standard quantity. How to calculate standard quantity? We'll always go by the format input output. We'll always go by the format input output. Look at here. What they mentioned, 15% is the loss. Look at here. 15% is the standard loss. So what we'll do? Input. If we give 100 kgs input, 15% loss means we'll get 85 kgs as output. But what is the actual output? 1700 kgs is the actual output. So how many kgs will be permitted? How many kgs will be permitted means you can do the cross multiplication. 2000 kgs. This 2000 kgs will divide in standard mix. What is the standard mix? 4:6. 4:6, nothing but 2:3. That is 800 kgs, 1200 kgs. Here I'll take 800, here I'll take 1200. 800 minus 830 minus 30 into 4 minus 120, that is 120 adverse. 1200 minus 1190. So 10 into 3, 30 favorable. Net amount is 90 adverse. You can cross check the answer. Look at here, 90 adverse. Okay. Next, material. What is the next requirement? Material yield variance. Material yield variance equal to what is the formula for material yield variance? 1 minus 4. 1 minus 4 SQ into SP minus RAQ into SP. So SP you can take common, SQ minus RAQ into SP. Now A, B, we know standard quantity. What is standard quantity? 800, 1200 minus, we need to know RAQ. We need to know RAQ. Standard price is 4.3. What is RAQ? RAQ stands for actual quantity in standard mix. So actual quantity equal to 830 kgs of A plus 1190 kgs of B, which equals to 1990, 2020, 2020. 2020. This will divide in C. Actual quantity is standard mix. What is the standard mix? 2:3. 2:3. So we can take it as 808. 808. 1212. 1212. 808. 1212. So difference is 8. Negative. Minus 8 into 4. 32. 32 negative adverse. 12 negative into 3. 36 adverse. Total 68 adverse. So you can check with this. Okay. Next, mix variance. Material mix variance. What is the formula for material mix variance? 4 minus 3, which is nothing but RA. Okay. 4 minus 3. What is 4? RAQ into SP. RAQ into SP minus 3. AQ into SP. So we'll take RAQ minus AQ into standard price. AB. What is RAQ? 808. 1212. What is actual quantity? Actual quantity is 830,190. 830,190 into standard price. Standard price is 4.3, which equals to 22 negative into 4. 88 adverse. 88 rupees adverse. Next, 1212 minus 1190 equal 22 adverse into 3. 66 favorable. 66 favorable, 22 adverse. Look at the answer, 22 adverse. So material cost variance. Material cost variance we can write simple. It is material price variance plus material usage variance. Price variance we already calculated. How much is the price variance? 376.25 favorable, usage 90 adverse. 376.25 minus 90, because adverse means negative, so which equals to 286.25. 286.25. That is the answer. So this is how we need to calculate the material cost variances. Okay, apart from this question, I can tell you one more question which is slightly complicated. That is in illustrations. In illustrations, they had given one question where they didn't given the standard quantity. In practical questions, remaining questions you can manage easily. This is also very simple question. Look at this question. Question number 4. Question number 4. In this question, what is the problem is here? 1 kilogram of product K require 2 chemicals A and B. The following were the details of product K for the month of June 2023. They given standard mix 50% of chemical A and 50% of chemical B. But how much is the standard quantity is not mentioned. Is not mentioned in the question. And one more thing, they didn't give the actual output also. There is no proper base, there is no proper information to calculate the standard quantity. There is no proper information to calculate the standard quantity. So in this question, they have assumed standard quantity equal to 100 kgs. They assumed standard quantity equal to 100 kgs, and they classified into 50% of chemical A and 50% of chemical B. 50% of chemical A means 50 kgs, 50% of chemical B means 50 kgs. So this question we have to solve by taking this assumption. Once you take this assumption, remaining all the information you can calculate very easily. There is no much complication in this question. As I told you, try to remember the formulas 1 minus 2, 3 minus 2, 1 minus 3, 4 minus 3, 1 minus 4. These formulas are similar for the upcoming variances like labor, variable overhead, fixed overhead, sales variance. In this video, I have discussed only material variances. I am going to discuss the labor, variable, fixed overhead later on. Are you understanding? So, and one more thing, many people are watching the videos but they are not subscribing the videos. Please subscribe my channel. Please subscribe my channel. Whatever the doubt that you are having, please mention in the comment section, so that definitely I can respond to that. Okay, so by this I am winding up the class of material cost variances. In the next video, I am going to make the labor, variable overhead and fixed overhead variances. Thank you so much. Okay, bye bye.